The month of May felt more like the month of March today, going out like a lion on Wall Street. The selling was modest for most of the session, but then in the last hour, it hit hard, wave after wave, as portfolio managers made month-end moves and certain indexes were rebalanced. That can lead to wild swings in individual stocks, and that's just what we got. Today's range from high to low on the Dow, 277 points, was the biggest since January 2nd. When all was said and done, the Dow finished 209 points lower, its worst performance since the day of the Boston bombings. The Nasdaq was down 35, and the S&P 500 was lower by 23. All three finished with losses for the week. Nevertheless, each of those major barometers ended the month of May with gains, the first time that's happened since 2009. The monthly win streak now, as we mentioned, stands at 7 for the S&P and the Nasdaq, 6 for the Dow.
Here to put the market moves in perspective, we have Jeremy Siegel, finance professor at the Wharton School, the University of Pennsylvania. Jeremy, you are predicting that the Dow gets to as much as 17,000 by the end of the year. Right now it's at 15,000. What is going to drive that kind of growth, and why are you so bullish on a day like this?
Well, as you guys mentioned, the end of the month, a lot of repositioning takes place. We did have a brutal week on yields, and what I really think is happening is the market is really pricing in the tapering of quantitative easing. And since so many people think that that's the source of the big gains, clearly there's going to be nervousness on that. But I think that it's gotten priced in pretty reasonably. I don't think it's quite as damaging as I thought it might be. Now, we'll wait till next week to see whether there's some carry through here. But you're right. I certainly don't think the highs have been reached. I'm still believe that we're going to end up the year between 16 and 17,000. On the Dow, and it's going to be mainly two factors. It's going to be good earnings, but multiple expansion. And even with rising yields, they are still so dramatically low. We can have multiples of 18, 19, and even 20 and not be at all unusual in a low interest rate environment.
So earlier this week, Professor, we had Mohamed El-Arian on, and he was concerned about the fundamentals. He was concerned about whether there was sufficient growth in the economy and corporate profits to justify stock prices at this level. That's why he says he's walking away from risk. How would you answer him?
Well, first of all, I don't believe we need big increases in corporate profits and earnings to justify even higher levels of stock prices. Don't forget, firms are buying back shares, so earnings per share is going up. There's a dividend yield that is over 2%, which is attracting more and more people, has a tax preference. If we get capital gains of 3, 4, 5%, it's going to beat bonds hands down. So I don't know where Mohammed is going to go with his money. I think PIMCO has already said the bull market is over on treasuries, so the move isn't there. Commodities look wobbly to me. We've seen what can happen to gold. It's not always the safest commodity. I still think stocks are going to be the asset of choice for most Americans.
Jeremy, real quickly, next Friday we get that important jobs report, and all week long next week, people are going to be anticipating that. So how is that going to set the tone for the week and for the month of June?
Well, it's the single most important report. I guess the morning line is what, 170? 180, and it'll move one way or the other. But most of what I see is that we are in a period of moderate growth, and given the fiscal drag with the taxes and sequestration, people are pretty amazed at how strong the private economy is, and that's what's going to drive us in the second half.
All right, we're going to have to leave it there. Have a great weekend. Thank you so much. Jeremy Siegel from the Wharton School.